The Fed just making its latest decision on rate cuts.
Let's get straight to CNN business anchor and correspondent Julia Chatterley. Julia, break it down for us. What's the decision?
There's good news for borrowers. The Federal Reserve delivering a 1/4 percentage point rate cut. It was a unanimous decision, and of course it adds to the 1/2 percentage point rate cut that they did back in September. In many respects, that's the easy part of today. The harder part comes next, and that's the press conference that we've got in around 30 minutes' time. And it's a case of the do's and the don'ts for Jay Powell and the Federal Reserve. What they do want to be talking about today is the fact that they've managed to engineer what we call a soft landing. They've hiked rates, they've avoided recession, at least for now, and they're very close to their inflation target. What they don't want to be talking about, quite frankly, is Donald Trump. Good luck with that. So where that leaves us basically is a situation where we know what's clear now is that while they can cut rates today, the future path of interest rates now is more uncertain. And what that depends on is the policy decisions of the president-elect, his government, of course, and who wins the House. Very important point to that, too. At worst, let's take the worst case. If he enacts mass immigration limits, mass global tariffs, it could slow growth. It could also raise inflation. Economists generally agree we could see 1 percentage point rise in inflation next year. That's going to slow the Federal Reserve down in their ability to cut rates. But of course, all we're doing is guessing at this stage, and that's the challenge for Jay Powell today. But I will say we are already seeing an impact for consumers, guys. I'm really closely following longer-term government borrowing costs, because these are very much tied to what we're seeing for mortgage rates in the United States. If you take a look at the 30-year mortgage rate chart, we're seeing mortgage rates rise right now. Now, some part of this is normal when the Federal Reserve cuts rates. You see these borrowing costs rise, but it can also be tied to the prospect of more spending. It can also be tied to the prospect of more inflation. So that's something I think that Jay Powell will also address today, even as he does his best to avoid talking politics, avoid talking about Donald Trump, and avoid talking about the things that he doesn't know yet. We have to wait to see what the government do.
Julia Chatterley, thank you so much for the update. Let's discuss now with a pair of analysts. We have Mark Zandi, chief economist for Moody's, and Doug Holtz-Eakin, former chief economist on the White House Council of Economic Advisors under President George W. Bush. He's now the president of the American Action Forum. Thank you both for being with us. Mark, first to you, your reaction to this rate cut. How exactly is this going to impact Americans?
Well, much anticipated, Boris. The Federal Reserve has achieved its goals of full employment. The unemployment rate's around 4%. It's low for all demographic groups and across the country. So check, they've achieved that goal. And they now have achieved the goal of getting inflation back down to their target, which is a 2% inflation rate, and they've done that. So they're now lowering interest rates to something that's more consistent with rates neither supporting or restraining economic growth, the so-called equilibrium rate, and they're on their way. They've got a ways to go, but they're well on their way, and that's all good news. And that's good news for American households and consumers, particularly folks that took on credit card debt or consumer finance loans or home equity lines of credit back when inflation was high to supplement their income to maintain their purchasing power. So this is good news. It should be helpful. It's going to take some time before this all translates through into lower credit card interest rates and consumer finance rates, but I think that'll occur over the next few weeks, a few months.
And Doug, what do you think?
Oh, I think Mark characterized it exactly correctly. The Fed is moving towards something that's more neutral. It's been leaning against growth in the economy, trying to slow the pace at which we get inflation. It's been largely successful in doing that. And so it is now moving back toward neutral. Given what we know, I think that it's exactly in the right place. The main part of the economic landscape, however, are the unknowns. What will the incoming Trump administration do with tariffs, with taxes, with spending, and what will happen in the global economy? So they're constantly rebalancing as they find out more about the conditions in which they're operating.
To that point, Doug, we have heard from mainstream economists this concern over the potential for tariffs installed by the Trump administration to be inflationary, and yet the stock market seemed to react positively to Trump's election. What's going on there?
Well, I try hard not to try to explain the stock market. The stock market has two components. One, The earnings of those firms that are listed on the stock market, and if their future earnings look better, stocks go up. And two, the path of interest rates and other competitive vehicles for your savings. You can put it in the stock market, you can put it in the bond market. So as people make different judgments about future interest rates and future earnings, you see the stock market move around. It can move a lot in a single day, and then they can reconsider it and it might pull back some. So it's best to look at the stock market over a sustained period. I think if we get to June of 2025 and you still see it rising at those kinds of rates, that'd be an enormous success, but I don't expect anything that large.
And Mark,
Hey,
Trump.
Boris, can I take a crack at that
Yeah.
question? Is that
Please.
okay? Yeah, in the stock market. I mean, in my view, it's because President Trump has promised corporate tax cuts. So, if you lower the corporate tax rate, that means the earnings, the after-tax earnings of businesses is higher, and that goes right to higher stock prices. And he's also talked about less regulation in a lot of different industries: financial services, fossil fuel, the telecom and IT industry. So less regulation means more profits, means higher stock prices. And he's probably also going to take a less kind of a jaundiced view of mergers and acquisitions. The Biden administration has been pretty tough on M&A in an effort to improve competitive pressures in industries to get prices down. But I think the Trump administration would be less likely to do that. So that's all positive for the stock market. And that's why stock prices, I think, are up to the degree that they are.
Yeah, and Doug, what do you think about his tariff plan? What are your concerns there? What do you think he's actually going to proceed with, and what he may not proceed with, considering he's proposed adding between 10 and 20% tariffs on every import coming into the U.S., with up to 60% tariffs on goods from China?
Well, I certainly think his track record shows he'll do the specific tariffs on China and probably some other countries and goods. The wild card is the across-the-board 10 to 20% tariff. I have no secret insight as to the firmness of that commitment, the pace at which it will happen, but that is certainly the hardest, for example, on the Federal Reserve. Right now we have the tax code in place, and there's going to be a big debate next year about extending it to some extent or modifying it a little bit, but that's current conditions, and the Fed's baked that into their calculations. Now they have to consider the thought of a 10 to 20% tariff. What do they do? You can make the argument that you put the tariff in, it pushes up the costs, it pushes up prices, but if the tariff only goes in once and they only go up once, so the Fed should just look the other way and go back to its business of controlling the long-term inflation rate. I think Mark and I would understand that, but I'm not sure the public that's very weary of inflation and very upset about high prices is going to think looking the other way is a sensible strategy. So do they then try to control it somewhat? Well, then their only option is to push interest rates back up and lean against what has been a very successful effort at a soft landing. So it's a real predicament for them to A, figure out what will he do, and B, how will they respond?
Doug and Mark, great insights. Thank you so much to both of you. You gave us a lot to think about and to maybe worry about in some cases too. Thanks, guys.